David Hutchison is going to lead this particular session. These folks are primarily providers of capital or advisors to providers of capital, and they will be the second aspect of this morning's session. David?
Thank you, David. Well, I think
that's the second
up in a way some of the themes that were developing in the last session. The headline is Scaling Social Impact Bonds. There are two dimensions to that I'm keen to develop with our panel. One is how we access deeper pools of capital, perhaps beyond the trusts and foundations who've been the cornerstone of progress so far, and also look at how we scale up operational delivery, which is a crucial part to building both the investor confidence and the commissioner confidence in this type of way of working. Just perhaps before we open up to questions and discussion with the panel, can I give you a bit of context? Looking at Peterborough, we were lucky to get the support of 17 investors for Peterborough. It took the best part of 6 months of fairly detailed discussions. Let me give you a sense of why a number of them came to the table. A number of them were trusts and foundations who've been active funding this type of intervention for many years and have been deeply frustrated that what was clearly working was not being picked up systematically by commissioners. What drew them to this is the potential, this is a new way of financing this activity. For a number of them, it also meant they could classify the investment within the endowment of their foundation, therefore opening up potentially huge capital resources which are beyond, if you like, the grant budgets. To give you a sense of scale, if all the UK trusts and foundations were to allocate 5% of their assets to this type of investment, we'd free up nearly £4 billion. Others had never invested in interventions of this kind before, but they were drawn to this financing technique because they felt that if we could develop a regime in which money was invested, returned, and potentially recycled, we could move to much larger scale and more sustainable ways of funding this type of activity. So I think we managed to pull together a number of different agendas, and I think that, if we're looking at the challenge of scaling, is something we want to develop a bit more in discussion. Enough from me, but let me turn to the panel and ask Victoria, Wal, Tina, and Jonathan to give their perspective, firstly on social investment and the SIB in particular. What's attractive and where they see the challenges? Victoria, one.
Thank you. When I was thinking about what I might say this morning, one of the things that sprung to mind, which perhaps doesn't sound very promising, is that the main driver for me, I think, for social investment over the last 10 years or so has really been a sense of frustration more than anything else. When I was running a small voluntary sector organisation, I was constantly frustrated by the fact that we could get money for things that other people were interested in, but not things that we knew we were good at and we could do more of. And that created a great sense of frustration in the organisation, and I'm sure that's familiar to a lot of people here. When I moved to the Sainsbury Family Trust, I think a number of grant-making trusts, ours included, who fund usually at an early stage, are very frustrated by the lack of exits for our grants. So we will spend quite a lot of time and effort getting organisations to the point at which they have a proven track record, they are delivering really great outcomes, and we would like them to move on to scale, to grow what they are doing, and we found that the opportunities for doing that were very limited. And I think finally, and possibly slightly more controversially frustrated, I think, by the inability of commissioners and other funders to take up and fund programs that have really great outcomes regardless of whether or not they are comfortable with their methodology. I think we found that some organisations provide services for people in ways which are slightly unorthodox, are a bit different. They might include lots of arts, they might include lots of things that commissioners worry about and other funders worry about. And so programs that have really had a very successful track record and outcomes don't get funded. So a few years ago, we were approached to make a grant to something which at the time, I think rather uncatchily, was called contingent liability financing. which was quite a hard sell for our trustees, I have to say. Thankfully, someone called it a social impact bond quite quickly. But at the time, it was called contingent liability financing. And we made a grant just to see whether or not this could provide the solutions to some of the problems that we were facing as grant makers. Now, I'm the first to say that I don't think social impact bonds are a panacea. I don't think they will solve all the problems we have in the public sector, and I don't think they are the only answer to how we grow and scale successful interventions. But I do think they help us solve some very old problems. They focus on outcomes, not outputs, which I think is crucial for a lot of people that are working in the sector. And they focus on outcomes, not methodology. So as I said earlier, too many really very fantastic programs that change people's lives are discarded by funders because they are perceived to be too risky or too unusual. And I think that the focus on the outcomes is crucial. The other two things I think which are really crucial to go back to my original background as someone who used to run a small organisation is the way in which the funding is received by the organisations delivering the interventions. I think if we can get social impact bonds to scale, then we can begin to fund organisations in a way which avoids 3 to 6 month opaque contracting. All the kind of stuff around complex local authority commissioning and other kinds of commissioning. So I think we have a tremendous potential.
Thanks, Victoria. Well, you wear two hats here as a trustee of a charity, a foundation that also obviously is a managing partner of ISEP Equity Partners. Comment really on wearing the first hat, how you see foundations engaging more directly in this type of investment. And then in the second hat, how perhaps some of the organizations you've backed might play a role in service delivery.
Okay. I'm a trustee of Guy's and St Thomas's charity down in southeast London. It's a rather privileged charity in the sense it's got a sort of £500 million endowment, if you will, and can take a very long-term view on how it addresses things. But, you know, we have one fundamental problem, and that is that we're captured by the past. The past in the sense that we have two buckets for how we look at money. We give it away, and that's a function of an average of the investment return we get, depending on whether it's 3 years, 5 years, or whatever. And then the other bucket is the assets we have to grow so that we can start giving it away. There's nothing in the middle. And actually, unfortunately, the way that you perceive social impact bonds when you first look at it is it's something in the middle. And there's a great education process needed to actually make sure that trustees can take on board, not that it's contingent liability bonds or whatever it is, but that actually you can put it in the bucket called grow the overall asset base, because the money comes back and you get a return. Oh, and by the way, you have a social impact as well. So that education process is ongoing, and I hope that, you know, with Social Finance Hubs, Guy's and St Thomas's might get there. In terms of the sort of other hat I wear, private equity, I got involved in this area through happenstance, really. Some of the companies we backed, the for-profit companies, there was a debate earlier on about for-profit, not-for-profit, involved in the sector. Well, we're in the for-profit area. And some of the companies we backed were run by individuals, social entrepreneurs, who developed a particular function, whether it's fostering or care for people in the community, and were looking for capital to grow the businesses and extend the quality of what they were doing. I then became chairman of the Private Equity Industry Association and started to think about how private equity interacts with that aspect and commissioned a report which the Young Foundation did. And what I found was quite incredible, that the involvements, not just of, not necessarily private equity businesses, but of individuals in private equity, bringing the skills they had to bear on the social sector was far greater than I ever imagined. And so businesses like, or companies like Impetus Trust, the Private Equity Foundation, who some of you may have heard of and are involved with, taking the skills of a private equity firm, taking an entity, trying to grow it, develop it, make it better, were run by private equity people. And St Giles Trust, which was on the previous panel, is one of the graduates of that program, and it's been funded by people in my sector. So for me, that was really interesting. Just looking at the way one can scale social impact bonds, if I can just go to that for a minute. I look at private equity itself, and I know many of you will know Ronnie Cohen, who's one of the sort of pioneers of private equity in the UK. If you'd asked him 30 years or so ago, I'm sure he'd have said it was a hard slog back then trying to get people interested in unquoted companies. And I look at this asset class we're trying to create here with social impact bonds, and it's almost the same journey. I hope it doesn't take 30 years, because I think the problem's so pressing, you need to get on with it. But there is a way to create an investment class here that actually, rather than people investing with their emotions, they're investing with their sort of heads and getting capital to flow in a place which is desperately needed. One of the methods I think that can be really employed to do this is individuals, getting people, high net worth, the mass affluent, if you will, to actually have an incentive to put money into this area. And I've got a sort of parallel, if you will, for this, and that's venture capital trusts, which is a way of getting individuals to get involved in unquoted companies, whether there's a tax advantage or tax incentive to do that as well. That might be a way of capturing interest quickly and really generating, improving the quality and flow of money to this area. So I said I've got 3 different ways of looking at this. And the nice thing is they all come together rather nicely when I sort of sit on the social finance board, which I do as well.
Thank you, Will. Which leads us neatly on to Tina. Tina works as the head of UK strategy for Deutsche and is actually, amongst many things that she's focusing on, helping them develop their approach to social investment. Tina, I know you're thinking about where demand for this type of asset might come from outside the trusts and foundations.
Absolutely. Maybe just to give a bit of background with regard to how Deutsche Bank has really ended up sort of in the social investment space and the work that we've done particularly over the last 12 to 18 months. Clearly we've, along with a lot of other large organisations, have a very active CSR approach. But what was very clear is increasingly we were being approached by intermediaries such as David and Social Finance to consider investments that not only had a financial return but also a social return. And we ended up having a lot of discussions internally over where should this sit. Should this sit within within the charity space? And the answer was very much no. The type of analysis that we needed to do to decide whether an investment was a good one didn't necessarily sit in a space that was just about deciding we were going to give a grant or a donation to charities, they went off to do good works, and that was pretty much the end of it. That there needed to be some sort of investment criteria, some sort of metrics around how we made those decisions. What made the area really quite exciting for us was the idea that as an incremental part of our charitable giving. So this is not something that we would say, okay, we have 100% of a pot, we're going to take 10% and put that into social investment. This was about an additional 10%, for example, that would be sustainable, you know, where we made investments. We did expect to get our money back. We did want to make a return, but clearly that return was not going to necessarily meet the internal hurdle rates for other businesses within Deutsche Bank. You know, so we had to really, you know, make a trade-off between that investment return and a social return. The reason why we have been working on setting up an in-house social investment fund is because, you know, ultimately that's where we have most control. Ultimately over our own money. So, you know, in the first instance, that's something we're very keen to do. There's been a lot of discussions around the role of foundations and high net worth individuals, which I'm sure we'll go into later. And clearly we have those types of connections. The largest pool of capital is obviously around institutional money. And I think somebody in the last panel was talking about insurance companies and you know, how do we access that, you know, those types of pools. Clearly, that is going to be very, very challenging. You know, given the fiduciary responsibilities that insurance companies, pension fund managers have for your money and my money, it's simply not as straightforward for them to say, I'm going to reduce my financial return because it has a social impact. So clearly, there are challenges in terms of accessing that pool of capital. You know, there are examples, for example, in the US, with the Community Reinvestment Act, which effectively encourages or coerces federally insured banks and thrifts to invest a certain percentage of their assets in helping their communities. And as a result of that, there's been tens of billions of dollars put into the social investment space in the US. So obviously, it's not something which it has to date really been culturally acceptable in this country, but ultimately, if one wants to really access that largest pool of capital, there may have to be some sort of change in terms of rules or regulation.
Tina, thank you. Jonathan, you're one of the biggest investors in the sector, but you also spend a lot of time thinking about service delivery. What thoughts have you got around the social impact bond and the challenges and opportunities there?
Yeah, I mean, we're a charity and a social enterprise, and we've invested about £300 million in third sector organisations through loans, grants and business support. The obvious observation is that it isn't about the money, and actually the entire premise of the social impact bond is that charities can provide better, cheaper services, and a percentage of that, the saving made, is passed back to the investor. So, and it was really a theme which was talked about this morning. How do you organise charities so they can deliver better, cheaper solutions which tackle some of society's hardest problems at a scale that has been hitherto not possible? And you will have heard the people who work in the charity sector talk about the problems of working together, essentially. So, from my point of view, what we need are new types of companies in the sector that can actually effectively organise service providers across a whole range of areas to provide or to deliver better, cheaper, more effective, radical solutions across a whole range of service areas, which will produce the results and will then pay the investors back. And our proposition, really, which is what we've done already, actually, is that the sector needs its own equivalent of a CIRC or a Capita. Now, before people get carried away by what that means, what I mean is organisations which can deal with financiers and bring in money, can bid for the largest contracts, and can then organise supply chains to deliver the outcomes. But in contrast to organisations like CIRC and Capita, which take, say, 20-30% margin, they can put those margins back into the supply chains, so the very charities that delivered the outcomes become stronger through their participation in larger contracts. So I think the social impact bond is a fantastic innovation because it is a means of catalysing better, cheaper solutions. However, I don't think its potential will be maximised unless we also create the sorts of organisations within the sector which can bring together charities and social enterprises to deliver transformative solutions on a scale that hasn't previously been delivered. So it's sort of half of the solution, and it's a critical half, but unless charities deliver services at an unprecedented scale, working together to produce brilliant things, then the investors, you won't get the savings, and the investors won't make the return on the investment. And just to pick up on one point about the ethics, this is a fantastically ethical innovation because the social impact bond is a means by which money is brought into the sector to facilitate transformative solutions to some of society's toughest problems that wouldn't otherwise have been tackled. So I think we should think about this as a profoundly ethical proposition, but we must think beyond the financing, otherwise social impact bonds won't meet their full potential.
Thanks, Tom. Just to drill into that a bit further, if you are investing or delivering, how do you like to see impact measured? Because I suspect that's a critical part of reassuring on the issue of ethics.
To view impact on as much as we can a kind of human scale. So, and we tend to be interested in measuring it over time rather than in a snapshot. So, and the difficulty with that is that it takes time to get the measurement in order to be able to demonstrate it. But equally, I think Jonathan's right that we need the scalable interventions, and we also need very robust interventions. And I think that takes time. So I mean, we like to see impact measured very much in human terms because it is I think it is the human. It is the benefits to individuals that will drive the savings to government, which will drive the returns back to the states. I mean, I think that's the crucial part.
I mean, Tina, picking up on something you said, which is that you had to look very hard at the hurdle rates of return in certain parts of your business. Now, presumably you are factoring in either implicitly or explicitly some form of social return. How do you look at measuring that, or do you expect to challenge that?
It's very much a hot topic, actually, internally, as we sort of create this fund. And when we have spoken, I think the social impact bond, the one that was issued last year, I think it's reasonably easy to measure the social impact because it's a defined pool of people, and the metrics are clear and they're transparent. I think where it becomes more challenging is when there is, for example, a number of different social investments within a fund, each of which are doing, very good things within their own community. And how do you actually then hold intermediaries responsible, for the type of social impact that each individual company is making? So I think there's two things. I would arguably say that actually with the social impact bond, it's actually very easy, because that is exactly how you're determining what investors get paid at the end of the day. What's far more challenging is when you look at it sort of in the round, and that's something which is very much ongoing within Deutsche Bank.
Well, then
but what I would say is our focus, and again, it's very difficult to define except to say that our focus is on life-changing as opposed to life-enhancing. And I think that is really an area of focus that we really do want to sort of hone in on.
Sorry, Jonathan.
I was kind of hoping that you wouldn't have to measure the social impact because the financial impact would be so self-evident. Rob Owen was talking about for every £1 that's put in, £10 is saved. There are many examples in health of interventions which are currently hugely expensive. So, for example, acute respiratory problems in hospitals, which if you dealt with in a preventive mechanism outside of the hospital could produce huge savings. For me, the exciting thing is if charities and social enterprises can tackle some incredibly expensive problems in such radical and effective ways that the financial saving becomes so self-evident that you don't need to justify it from a social point of view. The closer you get to the charity section, the more you work in it, the less emotional you become about it. And then you think, well, hold on, these things should work because there's a very strong, there's an absolutely compelling financial case for it. It was interesting, the lady from Tomorrow's People laid out exactly the financial benefits of her interventions. You shouldn't really need, in some ways, to demonstrate the social ones. The money should speak for itself, which is a slightly more controversial view.
Enough of our conversation. Let me throw it open to questions and for any aspect of this.
Hello. Hi, my name's Stephen Bediako from the Social Innovation Partnership. Just a couple points, really. One is, how do you scale up this type of thing without losing the fidelity and integrity of the original social impact bond? And then my second point is, I think it's all well and good that we're now pursuing outcomes, but again, how do you stop kind of perverse behaviors? So, I think about NHS waiting times, and when it was 4 hours and you had to be seen by a nurse and you were basically kind of met at 3 hours and 58 minutes and moved to another room. So I'm just wondering, how do you stop that kind of behavior emerging?
Scaling up. Jonathan, do you want to pick up on that one?
Yeah, I mean, we've got a vision for scaling up which we've actually done and which we think is a good model. It's a company called 3SC, Third Sector Consortium, that we started with people like the National Housing Federation and the Eden Project. And it's a company which has a supply chain of third sector organisations, some absolutely tiny and some very large. And it sorts delivery from that supply chain to deliver large-scale solutions, but it doesn't say to the tiny charity, become a big charity. It just buys a small set of services from a small charity. And to give you an example, 3SC delivered the largest Future Jobs Fund contract, and some of the charities provided a single job, and some of the charities provided 300 or 400 jobs. So we believe that there is a model, a company model that we've set up and we're running and we're attempting to scale up, which will allow essentially for you to remove the schism of large versus small. It will allow small charities, small, medium and large charities to work together to collectively deliver very large contracts without trying to stop small charities from being small charities and hence, to your point, losing their fidelity.
And a thought on perverse outcomes?
Oh, well, there's always perverse outcomes. I mean, I don't think there's anything much you can do about human nature, and I think it just comes down to the particularities of the contracts and how it's negotiated. It's just part of life.
Well, thought on growing organisations so they can...
I mean, I spend most of my life, day job, working with entrepreneurs and trying to sort of focus on growth and development. I think the key is to deliver, sustainable, high-quality outcomes, whether you're for profit or not for profit. It's actually irrelevant. It's that sort of focus on, if we're in fostering, looking after the child's being cared for in a way and a manner that means they'll emerge from whatever horror they've been in before a more fulfilled and beneficial sort of citizen in society. And I get sort of frustrated when people sort of talk about there's a conflict. There is no conflict. It's about the outcome. Focus on the outcome and delivering it. Don't worry so much about the delivery mechanism. And that's one of the problems that I think the last panel talked about, the frustrations of dealing with government and procurement processes. You design some huge monstrosity that has no bearing whatsoever on the outcome, and in fact, in many ways, acts against it. Entrepreneurship, social entrepreneurship, is about sort of breaking free of that, and the beauty of the social impact bond is it helps to focus in on that. It's the outcome that matters, and allows people to be innovative. One of the best ways of destroying innovation is to put a process around it.
Just to give a perspective from Peterborough, I mean, I'd love to say you could hardwire the outcome into a contract. You have to live the outcome. We have the benefit of a governance board of 7 individuals chaired by David Robinson, and we think about every pound we spend, and that's going to be an 8-year voyage in terms of delivering and not dealing with any perverse incentives that may creep in. More questions? I know there's one here.
My name is Steve Podmore of Transform Capital Management. We're launching what can be best described as a globally focused impact investment bank. I'm interested just to put the spotlight a little bit on social finance itself as an organization and your sustainability. So the title of this session is Scaling Up Social Impact Bonds. So my question is, you're currently funded as a not-for-profit, I understand.
We're a non-profit.
Yeah, and the sustainability in that entity, is that there, funded as you are as a not-for-profit? Just a question. The other point is, what number, or what would be the volume or the number of impact bonds or the total capital for you to actually have issued directly or indirectly for you to have achieved critical mass? And how long do you perceive that will take? So for it to be viable as a continuing entity. And it just draws into Tina's point around institutional capital and unlocking that. 5 million or 10 or 50, it doesn't move the needle for most institutions. So what is the point where this can become mainstream? Is it $500 million? Is it 250 million? Do you have any ideas on that? And the panel's thoughts, please.
Well, to give you a bit of background on social finance, yes, we're a non-profit. We were started by 4 philanthropists. We've subsequently benefited from support from the Sainsbury's family, from Rockefeller, from Esme Fairbairn, and most recently and significantly from the Big Lottery. So I think we are drawing interest from grant makers who essentially see the need for this type of intermediation in the market to develop these ideas. That is something where there is a significant level of interest, and part of the reason we've looked and set up a sister organization in the States is the level of fund interest in that type of activity. We are increasingly earning consulting revenues, fee revenues in respect of specific projects, but the ambition is to raise substantial capital and develop a sustainable model around that. I measure that journey in probably between 3 and 5 years. I think it'll take that time to get to critical mass. It took us 2 years to develop Peterborough. I think as a result of a number of the learnings, we can accelerate that process. Toby talked briefly earlier about some of the pipeline that we see. I think, rule of thumb, we would like to see somewhere between 50 and 60 million of capital raised over the next 24 months in this area around high-quality social impact bonds. I think, to be clear, and one of the points we're making here, the service delivery piece is extremely important, and we won't economize on that. to actually keep the fidelity of the mission is about building the confidence in the asset base. So we will not probably earn much margin in the near term on that. But as we see more volume, taking your point, opening up new pools of capital, and we should get others to contribute, I can see the earnings momentum in that. There is then also perhaps streams of income around asset management.
If I could say, and I think, Wal, you alluded to it a little bit earlier on, tax, I think, is a real issue here, in the sense that, if you do want to encourage, whether it's the man in the street that can do a give as you earn when they give a charitable donation, to a high net worth individual that is looking to invest £200,000 in a venture capital trust, it's not about giving specific or better tax breaks for social investment, but more actually creating a level playing field versus charitable giving. So when you are dealing with high net worth individuals, they'll look and say, well, actually, it's more efficient for me to actually give my money away than it is to actually invest in a social enterprise. So I think that level playing field is key in trying to unlock really the pool of capital that's within individuals.
Well,
I think there's one danger which sort of sits in the back of my mind, and that is that social impact bonds become the cure for everything, which clearly they're not. I mean, in David's comment about how long it took to get just the Peterborough thing up and running, navigating the complexities of how you design the measurement and satisfy the cashable savings involved, the not little task of constructing the consortium to deliver the actual process. My worry is that suddenly social impact bonds get sort of stamped on everything that moves, and actually what you have is investor disappointment. We tried it doesn't work, but did they really try it, or was it something that's really payment by results, or some other sort of bastardized version of what actually, in its purest form, can be so effective?
One over there.
Yeah. Martin Carr from Exemplas. From what's been spoken about, there's clearly money out there to invest in these things. There's clearly demand out there. What actually are the major obstacles of the money flowing to the people that want it? It's because they can't articulate what they want. And what are the reasons for it?
I think that there are some things, and it would be long and drawn out and dull to touch on it now. But I think that there are lots of hurdles for trustees of charitable trusts that make it more difficult for them to invest in things when it is, in my view, very much part of their mission and ought to be what they're doing, and part of the sort of market building will rest with trusts and foundations. So I think that there are some regulatory and other issues which need to be dealt with to make it easier. I think like everything, there is an issue about track record. The Peterborough Social Impact Bond has I think begun to break that down. And I think David was saying it's a sort of 3 to 5 year process. I think we need to get more high quality social impact bonds out there and encourage people by the quality of what's available, rather than simply talking about social impact bonds as a good thing. I think they rest, as we were saying earlier, they rest very strongly on the quality of the intervention and the quality of the work that they're doing. So I feel it's in that sense it's a little bit chicken and egg, because you've got to get them out there and get people excited about what you could deliver, rather than trying to get them excited about how much money they put into it before really understanding the interventions.
Jonathan, a word on blockages?
Well, I think to answer your question and the gentleman's question down here about how do you get 100 million or 200 million in, the money's in government and local authorities, isn't it? Ultimately, they're buying services, reduce crime or whatever it is. So ultimately, they're going to pay. So they have to be prepared to let large contracts to third sector organisations who then get their cash from the social impact bond, fundamentally. So you start with where the money is, and the money's in government and the money's in local authorities. So they need to initially have confidence that they could let a £200 million contract to a third sector consortia, because then you've got your demand for £200 million of cash flow, which kind of sets the whole thing off. So if you start with the money, the government and local authorities because they're the people who ultimately pay for the services, have got to believe in the model, both in the delivery model and the financing that comes with it. And so Peterborough is a start on the journey, isn't it, and an absolutely fundamental start. But again, it's building the confidence that it allows someone to let a contract at that sort of scale. And there are various pieces of work in that, you know, talking to government, convincing them that they actually do have confidence in a third sector supply chain. And there are many other parts of that influencing task. But fundamentally, I think you have to start with the fundamental challenge is the day on which the government lets out a £500 million contract to a third sector consortium, and that's financed by a social impact bond, and let's hope the thing works. At that point, you've got your market.
Louis Brooke from London Rebuilding Society. I was very interested in you talking about the Community Reinvestment Act in America, because I agree that 7% is not going to fundamentally change the flow of capital in the UK. So really just a question as to, with your hat on and looking at the social investment marketplace, you can see it might take regulation or legislation, but the Deutsche Bank cap on, how do you think as an institution you'd respond to that sort of regulation in the UK, which you're already used to being subject to in the States?
I mean, clearly, banks or financial institutions are being taxed on a number of levels above and beyond sort of the Community Reinvestment Act. So clearly, I think there's a lot of discussion to be had, I guess, as an industry as to, you know, where capital should go, what should it be spent on, should it be spent on you know, shoring up banks' balance sheets to avoid the next financial crisis, or should it be put to work in terms of a Community Reinvestment Act. Clearly, it's something that, you know, if it becomes law, it's something that we have the skill set to deal with. It's something we have a very big operation in the US that actually manages these types of funds. So it's something that we clearly have a track record in and have always been very supportive of. You know, are we sticking our hands up and saying, you know, yes, this should definitely happen? I think it's, you know, this market in the UK is so new at this point that one of the things which we have actually found is that even in funds that we have invested in, for example, over the last 12 months, have only themselves made 1 or 2 investments. And, you know, social, so moving slightly away from social impact bonds, you know, but social investments in general, trying to actually identify the right opportunities is something which is not something which, it's not like there's billions and billions of pounds just waiting to be spent in this space. You know, the market is actually growing reasonably slowly. So it's actually questionable whether were 20 billion pounds, you know, to be found, exactly where that would be spent and in what order. You know, so I think that there's a lot of work to do within the philanthropic space, within high net worth individuals, within charitable foundations, and obviously, you know, CSR activities of banks before necessarily we get to a point that there is an element of regulation and legislation.
There's also this issue of, so a gentleman over there mentioned the barriers to money coming in. I mean, we're going through a fundamental reevaluation at the moment of what it is the state does and how it delivers it, because a lot of what was in the sort of social sector, local authorities and things used to do, we need to get through this debate before you can get the scale and size of contract that, you know, requires 200 to 500 million pounds. You know, at the moment, we're still talking about very small scale, very, very focused point solutions, and it is a very early market. And I wonder whether the sort of, with the great respect, the skills, the management processes, the capital to invest in IT, etc., actually exist currently to take the money we're talking about. I suspect not. And that sort of goes hand in hand, and which is why it's going to take a bit of time for this to happen, but it doesn't mean we shouldn't focus on it. It doesn't mean we should try and seek changes to level the tax playing field to coerce the banks into providing some money. That shouldn't not continue, but it's sort of step by step.
Thanks, Will. I know there are a couple of questions over there. Let's take them both together.
Chris Robinson, I'm the Chief Executive of the Mayor's Fund in London. Question particularly for Tina, when you were talking about changing the tax scenario, you were comparing investment in social impact bonds to a charitable donation. But do you think there is the potential in social impact bonds to be considered by investors like Deutsche Bank purely as a commercial venture?
Probably not in its current structure, because if you're actually speaking to philanthropic organisations or to high net worth individuals, you have a different evaluation process. And the way that I would view it, a social impact bond, is to say, look, I can give £100 to a charity, and it's gone, and that's it, and they go off and do good works. Or I can give £100 to a social impact bond. If the outcomes are as expected, I can get my 7.5%. If not, I get 0. And actually, net, I'm in the same position as if I'd just given away the £100 million, the £100, or not. Whereas for an institutional investor, that's a very, very different investment decision. You're effectively asking an institutional investor to take, in sort of, I guess, financial jargon, you're asking them to receive a debt-like return for equity-type risk. In other words, they're not being compensated enough for effectively their investment to be completely wiped out. So in order for institutional investors, assuming one actually can get over the fiduciary responsibility, what really would get institutional investors involved is there needs to be far greater transparency around data. The cash flows need to be modelable so that investors can actually decide, is something rich, is it cheap, in relation to something else. And that's very difficult at this point, which is why it does occupy a space that is neither a pure investment decision or pure charity.
I think just a personal observation, certainly diversity of risk and professional management of that risk and track record is three of the gating items we come across. Although I think protecting principle is also another route to accessing capital. People may have a view on whether they receive a 0 return or a 20% return, but if they lose their capital, it moves the investment into a very different place. There's a question behind you, and there's one over there. I'll take both together so we can...
My name is Seth Eno. I work for Henderson Global Investors, and actually I wanted to ask a similar question to the previous person. I think perhaps a nuance which is being missed is that actually there's an asset class called SRI, Sustainable and Responsible Investors. And we have an explicit mandate from our investors to consider social impact as part of our investment process. So although typically we sit in mainstream investment houses like Henderson, we do have an interest and a tolerance and indeed a mandate to consider these kinds of things. So I think potentially that community can play an interesting stepping stone between the philanthropic kinds of capital and the mainstream capital that is looking for commercial level return. And the question that I was asking was, or wanted to ask was, how do you think the beneficiaries can help us get comfortable with the level of risk? And I think you began to address that in your last comments, but I would be interested to hear the other panelists' view on that as well.
Just before we take that last question over here.
Yeah, Neil Nerf, former health and social care manager, now working as a consultant. Comment and question. The questions are about preparation, due diligence, and one of the public sector's negative experiences around PFI was the effort which you had to go to in the industry itself to get the PFI set up. How can social impact bonds be delivered in a lean way, an efficient way at set-up and start-up stage? The other point is, would you distinguish between societal gain, which we were talking about with the Peter example, with fewer people suffering long-term prison sentences, and gain around reduction in crime and harm minimisation and so on, and very specific individual savings, because some public services are delivered in the way you talked about with Peterborough. Other public services actually do have a price attached to them, and commissioners are currently struggling to actually make savings when sometimes, investors save would reduce the actual cost over a longer period of time. Do you think there's an opportunity for SIBs where money is specifically attached to individuals? And there are some real ethical issues around that, but also there's some real delivery issues, and I'd be curious to hear what the panel thought about that.
Okay, three questions. Well, do you have a thought on managing risk for different groups of investors?
Actually, can I duck that one for a moment and just try the last question around local authorities commissioning and personal budgets, which I think is where you're going, which is happening in the healthcare sector. I mean, one of my fundamental frustrations with dealing with local authorities is, in many, many respects, they're both the commissioner and the provider. There's very little they don't actually do and commission at the same time, which is kind of curious because it makes you sort of look at everything you're procuring from a voluntary sector or private sector through that lens of, I've got my own thing here, how does what you're doing compare with that? That's a good case. A bad case is, I only ever use you when I've run out of capacity over here. They don't question whether it's the right model to have or whether the cost structure works, or if they do question it, it's kind of, fostering example, roughly, what, £800 a week to you pay to a private sector or a voluntary sector provider to find the carer, and that organisation's got to do the recruitment of the carer, the assessment of the carer, the training, the sort of monitoring of the carer, and then also pay the carer a fee. Local authority pays the carer £300 a week. Apparently, we're £500 a week more expensive. But are we? What about all the other costs? If you add them together, it's probably 2 to 3 times as much. Never gets talked about. So there's this great debate, which is currently happening, about local authorities commissioning and providing. And I think once you start to unlock that, you start to create the capacity for organisations to be built to deliver on the scale we're talking about that requires social impact bonds.
I want to draw things to a close. Part of the answer to lean delivery is today. What we're doing is trying to create an awareness and build a market so that you'll all have better access to intermediaries and individuals who understand how to progress thinking projects you've got. But one of the important parts of today is you give us feedback on what more support you need, and what we'd love to encourage is a market of many social finances effectively delivering these projects at scale, but it will take some time to accelerate the process. Fortunately, I think we've got some very useful technology which is available to you all, and as I say, that's the purpose of today. Thank you for all your questions, and particular thanks to the panel.